Hello and welcome to the first episode of Meet East Capital. The theme for today is Q2, and together with me I will have Jacob Grapengiese, the CIO of East Capital. It's been pretty hectic, hasn't it, Jacob?
Yeah, a bit too hectic maybe.
So what's your take?
Well, I've been spending my time in faraway places like Korea, India, the Middle East, and you, Peter, have taken over some of my old trips. I was about to say going to Eastern Europe, which is our home turf.
Exactly. I've been in lots around the Balkans, Baltics, Central Europe, and seeing what's happening there. It's a lot of activity there as well.
Yeah.
Shall we start with your impressions?
Yeah, we can start with my impressions. Absolutely.
Mm-hmm.
I think we need to start with the elephant in the room, I think, which is China, Taiwan, and geopolitics. So we had the Chinese market, unfortunately, quite weak during the quarter. It was down 10%. We're finding a lot of great, cheap and getting cheaper companies in China, and we should admit that there's a lot of talk about China possibly invading Taiwan. We need to mention that risk. Personally, I strongly doubt this will happen, but the background is that there is a large conflict about chips. It's a chip war. So the US is restricting China from getting access to certain chips, and now the Chinese are accessing the rest of the world of getting access to some crucial rare earth metals that are needed to produce these chips. So it's a chip war or a chip race, however you see it. And of course, Taiwan is the world's largest manufacturer of these chips, and this would be then the reason for China to possibly, invade or take over or something like that. Taiwan, reunify it with China, as they say. There's a lot of tension around this. There is talks about, US troops on the ground in Taiwan, etc. But at the end of the day, we need to remember that China and the Communist Party running China, they are really dependent on economic growth. And, to do something against such crucial industries as the chip industry, this would hurt economic growth, and this would really hurt China. It would probably hurt China more than many other countries because they're export dependent and manufacturing dependent country. But it is an issue, and this is why Chinese stocks are cheap. Having said that, we bought, for example, shares of Jinko Solar. It's the world's largest solar panel manufacturer. Solar installations are growing 43% this year, 45% last year. It's 100% in 2 years. And you buy the world's largest solar panel manufacturer at PE3.
And that's a key theme for us and a favorite theme for us over the last few years. And it's given a lot of alpha in our portfolios as well. So it still holds. So that's a good theme.
Yeah, absolutely. So maybe it was a long explanation, but I would say, so yes, there is geopolitical risk, but you buy the companies at PE3. Can they double from PE3? Yeah, I guess they can.
Any other impressions from Seoul?
Well, from Seoul, it's really all about EV batteries. So to simplify, you buy an electric car, half the cost is the battery, right? It's quite difficult to produce these batteries. There are a number of different technologies, and technologies are also evolving. I think for the consumer, you probably just noticed that, actually, this car can drive a little bit longer than the last one. It accelerates a little bit faster. You can charge it a little bit faster. Having said that, it's a bit like, I don't know, people were crazy about tech companies during Corona, and they all went up. But then they all came down, and some went bankrupt, some are in difficulties, right? So I think this is exactly where we are now for the battery companies, that some have leading technologies, some will do extremely well and be the future winners, and some not. And it's our job then to figure out which are the winners. My colleague Hao went to see some of the factories. We went in really deep, looked at the contracts, the technology, how will this company look 5 years down the road versus their peers. I personally think that there would simply be an enormous margin pressure, and then not everyone will make it, right, or rather make it with a good profitability.
Yeah, that will be another key theme for us. Just concluding a bit more on China, not on Asia, India.
Yeah, so India is a fascinating place. Both of us have been investing for a very long time in emerging markets. You, of course, longer, but you come to India and you just realize that this is, as we call it, the good old emerging markets. People want a better life. It's aspirational. They want, maybe it sounds ridiculous, but they want to buy a motorcycle, a microwave, a TV set, a car, a better house, etc. And you can really feel this, and it's such a strong power. I spent most of the time on looking at the other side of the equation, which is when people get old and they need healthcare, because obviously you have now a lot of young people, but that actually means that if they make money, they can afford good healthcare for their parents. This is how it works, right? So we looked at some of the healthcare companies, and there are a lot of statistics, but for example, in India, there are 70,000 good hospital beds. In the UK, it's 140,000. So India is half the UK, with a population that is 20 times larger. If you compare India to China, it is a coefficient of 12, i.e. that India needs to grow 12 times to get up to the same level of hospital beds per capita as China.
So what do they do now? Do they travel to other places for? Is it Middle East they go?
Yeah, they go to Dubai, right? Yeah. So I flew personally. I flew Dubai Delhi. It's a 3-hour flight. I guess there are 20 flights per day from Dubai to Delhi, so they just fly there. It's cheaper in Dubai than in Delhi because there's such tight capacity, and actually it's very expensive than with private healthcare.
Have you invested anything in the healthcare in the Middle East as well?
We are looking at some companies now, and actually one of the companies we have in India, they are present both in Dubai and in India.
Yeah, another interesting theme as well.
Yeah. But Peter, maybe we turn back now to Eastern Europe.
Eastern Europe, yeah. I think it's fascinating. I mean, of course, after 24th of February last year, it was a hard hit for many Eastern European markets. A lot of international money, the global investors withdraw their allocations to places like Poland and Romania and other places. We saw the amount of international investors sort of diminishing completely. And of course, if there is a war happening around close, you're maybe not that keen to be there. And I think that was the immediate reaction. But I think it went a bit too far. All these markets bottomed out in September, October, and they were on valuations which were almost on Turkish valuations, to put an extreme, sort of, i.e. very cheap.
Poland was P4, I remember.
Yeah, exactly. So, and remembering, of course, things are different, but Poland used to be the most expensive market in our universe. It was more around 20. There was, of course, also the pension funds buying a lot at this days, but still, it's a bigger derating. But what else can be said about this? I think it is.
We can add that our Balkan and New Europe funds, so the two funds we have exposed, and New Europe is mostly Central Europe, and then Balkan, as you hear, it's mostly Southeastern Europe. They are up both 18% year to date, so they're among the best funds we have, but I think also among the best funds in the kind of Swedish fund universe.
That's true, and it is really since the bottom in September, October. I think the Polish market is at 45-50% in that region.
Yeah.
So it is a recovery. And one reason is, of course, that there will be an end of this war. I mean, that's, sooner or later there will be an end, and a lot of the markets which are bordering Ukraine will benefit from that. That's pretty clear as well. The other thing is that we have these recovery programs after COVID from EU and also the EU cohesion funds that are about to be spent, have not been spent too much, but it's massive numbers that will be allocated to this country. So in a place like the top three, it is really, you have Croatia, you have Latvia, and you have Bulgaria, which are all around 35% of GDP in allocations from the EU between 2021 and 2027. And then you have places like Poland, Estonia, Lithuania around 20-25%. So it's massive numbers that will be invested in these markets. It will be infrastructure.
So sure. Just to make it perfectly clear, that is 3-4% of GDP every year for 7 years. these are staggering numbers,
massive.
right? You know, you say that a stimuli of maybe 0.5% or 1% of GDP, that's a big number, and we're speaking about 3-4%.
So I think it's pretty cool, and I actually think as well, I mean, one thing is that you see a lot of activity. I mentioned I've been traveling around in these areas, and I've been a lot actually visiting industrial companies and logistical parks and other things just to see what the economic activity is. It is a lot happening. We still see a lot of the nearshoring theme as well benefiting these places, that people start to think and question, should we have all our production in places like China or Asia, or should we move elsewhere? And Eastern Europe is of course a logical step. It's close, it's cheaper, and infrastructure is being handled in a good way. So I think that's a very strong theme, and I think we'll see more of that. Another interesting thing happening at the moment is Poland with the election. We know that Poland has had a very successful strategy of actually allocating money to the population through child support program. Child support, what do you say? Barnbidrag. It's
yeah, I think that's what it is.
It is
child support program. Yeah.
So they really had created kind of a floor in consumption for most people, that they get a lot of money from the state and they spend it. So we have benefited a lot in our portfolios from consumer-related names. I mean, you've been seeing quite a few of these over the years.
Absolutely.
What's your favorites?
Well, we have a company called Pepco. This is a low-cost, especially clothing retailer. I mean that it's a greatly managed company, but it's also one. I mean, these low-cost retailers everywhere are growing very fast, but here you have this huge migration flows.
Yes.
So of course, like a low-cost retailer, there is exactly what you need.
And just to be super clear, this migration from Ukraine mostly then.
Correct. Yeah. So a lot of people stay in Poland, either permanently or temporary, right? Some of them, of course, leave, but the flow might turn the other way around if there's an end to the war, right? But they will still pass through Poland, they will still consume things in Poland, and of course the Polish GDP will benefit massively if there's an end to the war, and we see investments going into Ukraine because all of that will be passed through Poland.
Another neighboring market is Romania, which has been some interesting activity as well. I mean, it's still there. I think we see that Romania is one of the broadest stock markets in Eastern Europe, and it's getting broader or bigger with an IPO happening at the moment.
Yeah,
Hydroelectrica. Yeah, do you have some impression on that one at the moment?
Yeah, absolutely. So we have the IPO Hydroelectrica. This is one of the largest hydropower companies globally, and this is going to be a big component of the Frontier Market Index. We participated in this IPO. It was massively oversubscribed, and I mean, to cut a long story short, you can say that you get above a 10% dividend yield for clean energy, de facto, right? For hydropower energy, which is pretty good. I don't think any peers would give you 10% dividend yield.
And just also to make it clear, this is something that not only interests investors in frontier markets and emerging markets, but people that want to invest in ESG themes. Clean energy, this is one of the best exposure you can get.
Yeah, and with that, and maybe to round it off a bit, I just looked at the numbers for our global emerging markets sustainable fund. So that's a global emerging markets funds, but with this ESG tilt. So you get this at the PE of 10. The index P is 13, but more interesting perhaps is that those companies are growing. The aggregate fund earnings are growing 21% this year versus negative 6%. So it's PEG ratio, if you look on these things, of around 0.4. Looking forward, I really think it's going to be all about inflation. Going to see US inflation starting with a 3. Personally, I think that this would make a huge impact in terms of how investors view inflation. Yes, core inflation is running at 5%, but headline inflation at 3 something, like 3.9 or 3.1, I don't think it really matters. But it means that inflation is starting to get under control. This means you can start to think about lower interest rates. Low interest rates means lower discount rates and hence higher stock prices.